Andy Lynch, not the first time you and I have talked about economic data telling us one thing and a market that tells us something else. Japan, you in the Nikkei?
We're sort of not in the Nikkei, but we do like some of the smaller companies. So the niche industrial companies in Japan, the exporters. Those are in really good. Many of those are in really good shape. They've got net cash balance sheets. They've got sort of leading technologies, whether it's in auto parts, in chemicals, in chemistry, and so they are actually going to really benefit from the weaker yen. And all the data today suggests very much that the Bank of Japan is going to have to push the yen down even further to try and kickstart the broader Japanese economy.
Sharmila, just to bring you in on this. Dollar yen, it tells me one story. The yen against the Korean won tells me another story, the same one. Euro yen tells me something different. How crucial is euro yen going to be in the quarters to come?
I think euro yen is very, very crucial this year. Okay, fine, yen dollar, you've seen a massive depreciation. Yen's been tumbling again. But a couple of points there. Number one is that, remember, the best of known Japanese multinationals, most of them are global companies, and they're diversified and they're sitting abroad. So they're relatively insensitive to movements in the yen dollar. Second is, if you look at actual Japanese export performance, it's been absolutely dismal. Exports in US dollar terms have been falling since April 2011, and it's getting worse. And this year, I think the environment is much tougher for the reason that you mentioned, that now you've got QE out of Europe. So the Japanese exporters, the domestic-based exporters, now have to look out for a more competitive Europe, in particular Germany, who they compete with directly. Our expectations is that Japanese export earnings going forward this year are going to start disappointing pretty badly, because you're already seeing export prices are falling very, very rapidly.
The currency effect is a story I've talked to a lot of people about, and they'd come on here and they said, we're long Japanese equities because we're long dollar yen. Then over the last 12 months, a lot of people talking about a change in corporate culture. Is that change in corporate culture giving more money back to investors? Is that going to offset a stabilisation of, say, dollar yen and a euro that gets a lot weaker against the yen, for example, Andy?
I think the change in corporate culture is a great story on a three-year view. It's not something that is going to make, frankly, any difference on a one-quarter perspective. But over the medium term, getting Japanese companies to focus more on return on equity, to sort of address some of the very large cash piles that many of them have on their balance sheets. In some cases, you get companies that are trading pretty much at the value of the cash they have on their balance sheets, and these are profitable businesses, not ones that are in distress. That will be a very significant long-term driver. But on a quarterly basis, no, it's not going to drive things quickly enough to make the next quarter look better or worse.
Sharmila, Japanese politics used to be incredibly volatile, and then we got Mr. Abe coming along and things seemed to stabilise. At what point do Japanese consumers and the Japanese electorate become as exhausted with Abenomics as some investors might become?
I would say they are well and truly over Abenomics, and they're totally exhausted. And, the numbers bear out. I mean, Abenomics is a failed experiment. The purpose of Abenomics and Bank of Japan QE was twofold. One was to raise inflation above 2%, and the thinking was that by raising inflation it would encourage consumers and companies to bring forward consumption spending and investment. The second one was to deliver an export rebound by weakening the yen and restoring competitiveness. We've talked about the second one. That still clearly has not happened. But the first one, the logic is flawed. Here you're talking about an aging, dis-saving economy. In an aging, dis-saving economy, when inflation goes up, you're destroying the real savers by driving down the real rate of returns. And that has got negative consequences for consumption spending. And earners have been no better off. So last year, you've seen the biggest fall in real earnings in 25 years. And on the back of that, you saw real consumption spending falling at the fastest rate for the data on record. And you've seen today's numbers. That trend continues. I mean, neither companies nor consumers are, convinced at all, and are pretty disillusioned.